Hey everyone, welcome to the Personal Finance Podcast. I'm Daniel.
And I am Anna.
And we love exploring things about personal finance as well as understanding how global news and trends impact our wallets.
Let us remind you that we are not financial advisors, but we dive into TED Talks, interviews with the best investors, books, news alerts, advisors analysis, and more.
You don't need to be a Wall Street expert to make smart decisions with your money. This episode is for you if you want to be able to think like a CEO of your own life.
Let's dive in.
I have to confess something. It's a little embarrassing.
Oh, yeah.
I woke up this morning, 6:30 a.m., haven't even brushed my teeth yet, and I grabbed my phone.
The classic mistake.
I tell myself, I'm just going to check the weather, right? Just, see if I need a jacket. But some muscle memory takes over. I open a news app, and boom.
Let me guess. Red banner?
Red banner. All caps. Market teetering on the brink. And for a split second, my heart rate it spikes.
It's the worst way to start the day. It's that immediate fight or flight response, but instead of running from a lion, you're worrying about your 401k.
Exactly. And the instinct is so visceral. I felt this sudden urge to log into my brokerage account and just, sell everything, put it all in cash.
Go bars.
Bury in the backyard, maybe. It feels like if I don't do something, I'm being irresponsible. But that panic response, that is exactly what we need to deconstruct today.
It really is, because that urge to do something is often the single most destructive force in investing.
So that's the plan.
Yep. We're doing a deep dive today into a really compelling guide. It's titled, Don't Let the Media Scare You, and it comes from Andrew Langdon.
Right. He's the founder of 5 Points Financial Planning. And what I love about this source material is that Langdon isn't just giving us stock tips. He's basically acting as a psychologist here.
Yeah, that's a good way to put it.
He's trying to expose this fundamental mismatch between what the media industry wants from us and what we, as regular people trying to build wealth, actually need.
It's a clash of agendas. And if you don't understand who is playing what game, you are going to lose.
So that's the mission for this deep dive.
Exactly. The goal is to figure out how to be boring enough to be profitable and how to survive the noise of massive geopolitical events. We're talking elections, wars, tech billionaires going rogue without, wrecking your financial future.
So let's get into the ring. In one corner, we have the media. The other corner, the investor. Langdon says they are playing completely different sports.
They really are. Think about the business model of a modern media company. What is their currency?
It's not my net worth.
It's definitely not your net worth. It's your attention.
Views, clicks, time on page, all that stuff.
Precisely. And human psychology dictates that we pay much more attention to danger than to safety.
Oh, for sure.
If a headline says, stock market likely to compound at 7% annually for the next decade with minor bumps, who clicks that?
Nobody. It's boring. I definitely wouldn't click that at 6:30 a.m.
But stock market Armageddon.
That gets the click.
Every time.
And that creates an incentive structure where the media must sensationalize to survive. They need to keep you in a state of heightened emotion, usually fear or outrage, to keep you scrolling.
But that's the conflict, isn't it?
That's it right there. Your goal as an investor is growth. And growth requires time, patience, and calm.
So if I react to their agenda, which is, get scared and click, I'm actively sabotaging my agenda.
Which is stay calm and compound. It's like taking driving directions from someone who wants you to crash just so they can film it for TikTok.
That is a terrifyingly accurate analogy. Langdon's point is you have to divorce your decision-making from the news cycle. You just can't let the headlines drive the car.
Okay, but this is the hard part. If I'm not steering based on what's happening in the world, if I'm ignoring the red banners, what am I steering with?
Right. You can't just close your eye.
Exactly. I can't just hope for the best. Langdon talks about a control framework, right?
He does. And this is the anchor. When the world feels chaotic, you have to pivot your focus relentlessly to the variables you actually have power over.
So what are they?
Langdon identifies 4 specific levers: time horizon, risk, costs, and taxes.
Okay, I want to drill down into these because they sound like textbook terms, but the application is where people mess up.
Yeah.
Let's take costs first.
Good place to start.
I feel like most people ignore this.
Yeah.
They think, oh, a 1% fee, that's nothing. The market moves 1% in an hour.
And that is the most expensive mindset you can have. Langdon calls costs the silent killer.
Wow.
Let's just do the math. If you are paying a 1% fee to a fund manager versus, say, a 0.1% fee for a low-cost index fund, it doesn't sound like much today.
But over 30 years.
Over 30 years, you compound that because that 1% is taken out every single year, regardless of performance.
And it's taken from your principal, which means that money can no longer compound for you.
You got it. Over a lifetime of investing, that difference in fees can eat up 20 to 30% of your final portfolio value.
Wait, really? 20 to 30%?
We're talking about hundreds of thousands of dollars for the average retiree just vanishing into fees. That is something you can control today.
That's wild. So checking your expense ratios is actually $1 million move, unlike checking the headlines.
There you go.
What about taxes? That feels like something the government controls, not me.
The rates are sure, but asset location is in your control. This is a bit nerdy, but it's crucial.
Okay, break it down.
Are you holding high-yield bonds or REITs, things that get taxed heavily in your taxable brokerage account?
I see where you're going.
If so, you're basically volunteering for a pay cut. You should be sheltering those in your IRA or 401k.
Right.
Optimizing where you hold your assets so you pay the legal minimum in taxes. It's a huge lever for growth. It's not sexy. It won't make a headline, but it works.
And then we have the behavioral side, the tinkering problem. I love this term.
B2.
Tinkering sounds so harmless. It sounds like my dad working on a toaster in the garage.
Mm-hmm.
But in a portfolio, tinkering is, well, it's bad.
It's lethal. Langdon cites research showing that the more an investor touches their portfolio, changing allocations, moving in and out of sectors, trying to time things,
The lower their returns are.
the lower their returns are.
It reminds me of that story, I think it was Fidelity, where they looked at their best performing accounts over a 10-year period.
Mm-hmm.
Do you know who had the best returns?
The people who forgot their password.
It's even better. The people who are dead.
The ultimate passive strategy.
It's morbid, but it's true, because they literally couldn't tinker. They couldn't panic sell in 2008 or 2020. They just held.
That is the aha moment. Laziness or maybe deliberate inactivity is a superpower.
Right.
The research shows that when we try to time the market, like selling because we think a crash is coming, we have to be right twice.
You have to sell at the top.
And you have to buy back from the bottom.
Nobody gets both right. You sell, the market dips a little, then rips higher, and you're left on the sidelines holding cash while inflation just eats it alive.
Precisely. So Langdon's advice is to stop tinkering. Set your risk tolerance, which is your risk lever, before the crisis happens.
When you're calm.
When you're calm. If you know you freak out when the market drops 20%, don't have a portfolio that's 100% stocks, dial it back.
I want to pivot here, though, because everything we've said makes sense logically. Don't look at the news, focus on costs.
Mm-hmm.
But we are human beings living in a very loud world, and sometimes the news isn't just noise. Sometimes it's a massive election or a war or a fundamental shift in the economy.
You're absolutely right. We can't pretend that big events don't have consequences.
Right, so let's look at the examples Langdon brings up. A Trump election or Elon Musk making a massive business move. These aren't small things. If I'm sitting there ignoring them, am I being negligent?
It's a great question, and Langdon acknowledges that these events, like a Trump presidency, do ripple through the economy.
Okay.
But he distinguishes between headlines and sector impacts.
Break down.
Okay, take a Trump election. The headlines might scream instability or trade wars, and that causes general anxiety. But the actual economic impact is usually specific to certain industries.
I see.
Maybe a new administration pushes for deregulation in energy. Well, that's good for oil and gas stocks. Maybe they want to renegotiate drug prices. That creates volatility for healthcare stocks.
So it's not that the entire market explodes or collapses, it's that the pieces move around.
Exactly. It's a rotation. If you're a diversified investor, meaning you own a little bit of everything, the winners in your portfolio often offset the losers.
But if you react to the headline, Trump wins by selling everything.
You miss out on the sectors that are about to boom.
And what about the corporate side? The Musk example. One tweet from that guy seems to send stocks on a roller coaster.
It does. And this highlights the difference between investing in companies versus investing in the market. If Musk tweets about a new strategy for Tesla or a regulatory hurdle for SpaceX, that stock is going to swing wildly. If you are holding just that one stock, your blood pressure is going to be tied to his Twitter feed.
Which sounds absolutely exhausting.
It is. But if you are a long-term passive investor holding an index fund, Musk's moves are just texture. They are noise within a much larger trend of thousands of companies.
This brings up a distinction Langdon makes between the active investor and the passive investor. I feel like a lot of us think we are active investors because we have a Robinhood app.
And that is the danger zone. Langdon notes that for true active investors, we're talking professionals, traders, people with Bloomberg terminals, these events are opportunities.
Right.
They're looking for that sector volatility we talked about. They want to short healthcare or go long on energy based on a policy rumor.
But they are playing a zero-sum game against other pros.
Correct. And for the rest of us, the passive investors saving for retirement, treating these events as actionable is a mistake. For us, a dip in the market caused by political uncertainty isn't a signal to sell.
What is it then?
It's just short-term volatility. It's a pothole on a 20-year road trip. You don't sell the car because you hit a pothole.
I like that. But let's play devil's advocate again. Let's say I am smart. I read the news, I see a crisis coming, maybe a pandemic, maybe a housing bubble. Why can't I beat the market? Why can't I just sell right before the bad stuff hits?
Now we get to the most humbling part of Langdon's guide.
The concept of market efficiency.
The very same.
This is the part that tells me I'm not as smart as I think I am.
It's not about intelligence, it's about speed. The concept of market efficiency essentially says that the current price of a stock already incorporates all publicly available information.
So by the time I read the headline,
It's already over. Think about the mechanics. Information travels at the speed of light. Algorithms scrape news sites, social media, even satellite imagery of retail parking lots.
wow.
They process that data and execute trades in microseconds.
So when I wake up at 6:30 a.m. and see bad news and I decide to sell,
You were selling to someone or something, an algorithm that already knew that news 3 hours ago or 3 milliseconds after it broke and has already adjusted the price down.
so I'm not avoiding the crash.
You are locking in the loss.
That is a brutal reality check. It's like arriving at a Black Friday sale at 4:00 p.m. and wondering why all the TVs are gone. The pros camped out overnight.
That is a perfect analogy. The retail investor is always late to the party if they are trading on news.
And this is why Langdon emphasizes that trying to profit from public information is so difficult.
It's extremely difficult. The market is an information processing machine that is vastly more efficient than any single human brain.
So if I can't outsmart the market, and I shouldn't react to the news, and I shouldn't tinker, what is actually driving my returns? If I'm just sitting there, what is making the line go up?
This is the comforting part. Beneath all the noise, the tweets, and the panic, there are fundamental drivers.
Okay.
Langdon lists 3: earnings growth, competitive advantage, and broad economic trends.
Earnings growth. That's just companies making more money, right?
Simple as that. Are companies selling more widgets, more software, more services? If corporate earnings grow over time, stock prices generally follow. It doesn't matter who the president is. If Apple sells more iPhones, they become more valuable.
And competitive advantage, that's the moat.
Right. Does the company have a brand or a technology that protects it? And then you have economic trends, population growth, innovation, productivity increases. These are slow, boring, glacial forces.
But powerful.
Very powerful.
It's like the tide versus the waves. The news is the waves, choppy, scary, loud. But the fundamentals are the tide, just slowly coming in.
And Langdon wants you to bet on the tide.
So practically speaking, how do we implement this? Because it takes a lot of willpower to sit on your hands when the world feels like it's burning.
It does.
Langdon talks about having a strategy before the chaos.
Yes. You cannot build a storm shelter while the hurricane is already tearing the roof off. You have to define your strategy when you are calm. Why are you investing? When do you need the money?
So if I need the money for a down payment in 6 months, I probably shouldn't be in the stock market at all.
Exactly. That money should be in cash or short-term bonds. But if you need the money in 2045, then a 20% drop in 2026 is, well, it's irrelevant.
So you have this written plan.
And it acts as a psychological shield. When the headline screams doom, you look at your plan and say, does this change the fact that I need this money in 20 years? And the answer is usually no.
It's about building a gap between the stimulus and the response. The headline is the stimulus.
And the plan allows you to choose not to respond.
Which brings us back to the emotional cycle. We touched on this, but it bears repeating.
For sure. The market is a mechanism for transferring wealth from the impatient to the patient.
Right. When you react to doom headlines, you sell out of fear.
Usually near the bottom.
And when you react to boom headlines, you buy out of greed.
Usually at the top.
Buy high, sell low. The classic recipe for going broke.
It sounds funny, but it's tragic. We see it in the data every single year. The average investor significantly underperforms the very funds they are invested in,
Just because they jump in and out.
just because they jump in and out at the wrong times.
So let's bring this all home. We've unpacked Langdon's guide, and I feel like my blood pressure has actually gone down a few points since we started.
That's the goal.
Let's recap the toolkit for our listeners. If you want to stop the media from wrecking your portfolio, what are the key takeaways?
Okay, first, acknowledge the agenda clash. The media sells fear. You are buying growth. Don't let their business model destroy yours.
Treat the news like entertainment, not financial advice.
Second, use the control framework. You can't control the Fed or an election. You can control your costs, your taxes, and your risk exposure. Focus your energy there.
Third, beware the tinkering.
Don't just do something. Stand there. The data is clear.
Yeah.
The less you mess with your investments, the better they tend to perform.
And finally, respect the efficiency of the market. You are not going to beat the algorithms by reading a push notification.
Just accept that you are late and realize that being late doesn't matter if you're playing the long game. You aren't trying to beat the next 5 minutes, you're trying to win the next 2 decades.
It really reframes the ideal investor. We usually picture that Wolf of Wall Street type screaming into a phone, adrenaline pumping.
Yeah.
But the actual winner is, well, kind of boring. They're stoic. They're disconnected.
They're the person who checks their account once a year to rebalance and spends the rest of the time living their life.
Which is honestly a much better way to live anyway. Who wants to stare at charts all day?
The me.
I want to leave everyone with a thought to chew on. We live in a culture that glorifies action. Hustle culture, make moves, take charge.
Right.
If there's a problem, we're taught to fix it immediately.
It's deeply ingrained in us.
But Langdon is suggesting that in this one specific area of life investing, inaction is actually the highest form of discipline. The hardest thing you can possibly do when your screen is red and the pundits are screaming is to simply do nothing.
It requires an immense amount of courage to be passive.
So ask yourself, why is inaction so terrifying? And how much wealthier would you be today if you had just learned to sit on your hands 5 years ago?
That is the question that might just pay for your retirement.
Thanks for diving in with us. Stay boring, and we'll catch you on the next one.